Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the Stockstowatch and the stock market news you need to know. And Nation, it's only with a heroic rally late last week that the market was spared more panic. The market index, S&P 500, is now down 3.7% from its all-time high on July 16th. That's not exactly a crash, though it might feel like it to some investors with heavily concentrated portfolios. Nvidia is now down 20% from its high less than a month ago. Tesla was down 12% just last week, and the tech-heavy Nasdaq was a breath away from correction territory, down as far as 9% last week. I'll detail what's happening and what to expect for the rest of 2024, along with market news on the busiest week for earnings and updates to shares of SOFI Technologies, McDonald's, and the Magnificent 7 stocks. But first, if you've ever wondered what's in my portfolio or want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. The app was created by YouTuber Brandon Beavis for investors and by investors. I just started using it last year and love the app for getting ideas and sharing my portfolio. And this isn't just another social investing app. You can connect your brokerage account or just input your stocks to track all your stocks in one place. You'll see the insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 150,000 investors in that social feed to see what everyone else is talking about. I've shared my portfolio on the app and it's totally free to download, so look for that invite link I'll leave in the description or just scan the QR code here. Back to our main topic though, and I don't want to scare anyone or lead you to believe that we're heading for a big drop in stocks. It might feel like that for some investors though, so I want to review where we're at in the market over the last few weeks and how to invest. I say it might feel like a crash for some of you because we seem to be going into one of the market's characteristic regime changes, and what's worked over the last few years is now falling apart. Case in point, while the broader S&P 500 market index is down less than 4% from its peak, shares of the Magnificent 7 tech stocks that have produced 100% plus returns are now down double digits. Nvidia is down 20% in 2 weeks, and Tesla broke its months-long rally to crash 12% last week alone. In fact, the Magnificent 7 stocks of Tesla, Nvidia, Apple, Microsoft, Meta, Alphabet, and Amazon have lost over $1.6 trillion in market value just since July 10th. And a big part of the pullback in big tech has been the realization that investment spending in AI in the hundreds of billions of dollars annually could take longer than hoped for to start paying off. The Mag 7 alone are expected to spend a combined $400 billion each year to build out those frontier technologies, much of that for AI chips, modeling, and training. Now, leading up to the second quarter earnings reports, analysts have been worried that that level of spending would severely detract for earnings, and we saw a glimpse of that last week with Alphabet, ticker GOOG. So we see some of that sheen coming off of the AI fervor, but if we look more broadly, the market isn't in too bad of shape, and there are plenty of catalysts to push stocks higher. First though, let's make a distinction between the market crash or a bear market and the less painful corrections and pullbacks. Now, a stock crash or a bear market is when the market index, usually that S&P 500, has fallen 20% or more from its recent peak. That would require another 16% drop from here, and there's nothing that points to that happening. A correction, on the other hand, is defined as a drop of 10% or more from that market peak, while a pullback is a dip of 3 or 5%, which is where we find ourselves right now in the market. Because of the overweight exposure to the biggest tech stocks, just that Mag 7 stocks alone make up 30% of the S&P 500 index. There is a good chance we see a legit correction as money rotates out of big tech into the rest of the market. It's going to feel like a crash, though, for anyone in those Mag 7 stocks, which could fall much further than that simple 10% correction. Looking deeper here, sector-level price-to-earnings valuations show a generally expensive market, but with some opportunities in those rotation sectors. The FactSet Earnings Insight shows the price of stocks in each sector against expected earnings over the next year for that forward PE ratio. 7 of the 11 sectors are now trading at valuations above their 10-year average, with tech stocks the most expensive here at 28.5 times PE. That is a 37% premium to the long-term average. Also relatively expensive are the stocks in industrials, materials, healthcare, communication services, and financial sectors, while stocks in consumer discretionary, consumer staples, real estate, utilities, and energy sectors are trading close to or below their long-term average PE multiples. Altogether, the S&P 500 at 20.6 times forward earnings is just 15% more expensive than its long-term average. So while that sell-off may still have 3 to 5% left to run, especially in those most expensive sectors like tech, there are very strong catalysts that should keep this bull market and stocks heading higher over the next few years. First of which is that interest rates are set to start coming down in September. The Fed isn't likely to lower rates as quickly as it raised them, but the market is pricing in the likelihood of 6 rate cuts by mid-2025. Taking as much as 1.5% off interest rates would go a long way to lowering consumer debt burdens, making housing more affordable again, and supporting the real estate market. In our June 10th update, I also highlighted another catalyst that could be unlocked by those lower interest rates: the giant surplus of cash sitting in home equity, money markets, and checking accounts. High interest rates have kept people from tapping their homes as a piggy bank, while rates have also kept cash sidelined in yielding accounts. Altogether, of the $42 trillion of value stored in just these 3 sources, at least $13 trillion could be unlocked with those lower rates, and much of that flow into the stock market. Another catalyst is the rebounding profit margins and expectations for strong earnings growth over the rest of this year and next. Record inflation caused net profit margins at S&P 500 companies to plunge lower from 13% in the second quarter of 2021 to a low of 11.2% by Q4 2022. Operational cost cutting has since brought those margins back up to 12.1% last quarter. Lower interest rates and further cost cutting are going to help it support further and will drive a boom in corporate profits. Analysts are now expecting earnings to rise 10.5% this year and a very strong 14.5% next year to almost $279 per share for the companies in that index. That alone would go a long way to supporting stocks, bringing the current PE ratio from almost 26 times to under 20 times price to earnings. So catalysts for stocks are extremely supportive that any further drop in prices is a buy the dip opportunity, but we are likely to have further to go in that rotation theme. I continue to recommend broadening out your stock exposure into funds like the S&P 500 Equal Weight ETF, the RSP, which holds each of the stocks in equal proportion, as opposed to the Market Index or SPY fund, which overweights those biggest tech names. The RSP is holding on to a 0.7% return over the last 2 weeks, even as the S&P 500 has fallen nearly 3%, and tech stocks have dropped even more. I also like the small cap stocks here in the iShares Russell 2000 ETF, the IWM, as companies that are generally more sensitive to interest rates and should get a bigger boost from Fed cuts to come. This doesn't mean you need to rush out and sell your shares of those big techs like Nvidia, Google, or Amazon. Take some profits, rebalance into the broader market, but these tech heavyweights are still going to produce good long-term returns, and time will come within the next 6 months to a year that we're going to see some very good deals. Looking now at the stocks I'm watching this week, going to be a very big week for earnings. First up, SOFI Technologies, ticker SOFI, reports its earnings on Tuesday, and I have to be a little worried for one of my favorite long-term stocks. Fears on consumer lending and defaults have weighed on this entire industry this year. Ally Financial, the only peer to have already reported its earnings, was down 3% on its report, showing revenue in line with expectations, but net charge-offs, so those defaulted loans, were up 9% from last year, and it did increase its provisions for bad loans. That's the big worry for SOFI, is that hit to earnings on the loan performance. Their shares are close to fairly priced at 1.3 times price to book, so I wouldn't be adding any more shares before earnings, especially since I already own just under 40,000 shares, but would be buying it on any dip. SOFI is still adding users and depositors at a pace that is unheard of in banking, and the long-term upside is still intact. EVGO, ticker EVGO, is up 57% since highlighting it as a short squeeze opportunity on June 28th, with the rest of the stocks in that video up an average 16.7% in just 1 month. Shorted shares are down to 2 million as short sellers run for cover on this, and the stock is still a good valuation on that upside to EV charging theme. Earnings are still expected deeply negative for the year, but on a very strong 54% revenue growth. I'm holding it along with ChargePoint Holdings, ticker CHPT, on the charging theme over the next year. McDonald's, ticker MCD, could confirm deep trouble in the quick service restaurant industry when it reports before the market opens on Monday. Shares of the French fry supplier Lamb Weston, ticker LW, were down more than 30% last week when it reported sharply lower revenue on a double whammy, really, of higher prices and fewer customers at fast food restaurants. McDonald's alone makes up 13% of Lamb Weston's revenue, so there is a good chance that the house that Ronald built surprises to the downside on Monday. If it does, investors should also be watching out for others in the space, including Yum Brands, ticker YUM, which is going to be reporting August 6th, and Wendy's, ticker WEN, which reports later this week on Thursday. Those Magnificent Seven stocks are going to be finishing up their reporting this week as well, with Microsoft on Tuesday, Meta Platforms on Wednesday, and then Amazon and Apple on Thursday. It was disappointing earnings from the other 3 of this group that sparked last week's sell-off, with Alphabet down 4.3%, Nvidia down 4.1%, and Tesla plunging 13% when each of them reported their earnings. The rest of the group fell in sympathy, but really held on better in that hope that they can continue to beat earnings. That said, returns on the Mag 7 stocks have been very good this year with the exception of Tesla. Nvidia is still up 127%, followed by Meta up 31%, Alphabet 19%, and Amazon 19%, Apple up 13%, and Microsoft lagging at 12% here. And so valuations are still pretty high on this group. While investors should have some exposure to these tech giants long term, the likelihood that we see those disappointing earnings from the remaining 4 stocks this week, you might want to cover some of your positions just a little. Showing you that bigger picture here with the SectorSpider.com sector tracker, 7 of the 11 stock sectors did close higher last week, despite the loss on the overall market index. Now that losses in technology, communication services, and consumer discretionary alone were able to drive that index loss really shows you they're overweight in the market and confirms the rotation out of those recent market darlings and into the broader market of stocks. 5 of the winning sectors on the week gained more than 1.3%, and it's in here, utilities, materials, industrials, healthcare, and financials, that investors should be looking for those rotation stock bets. Now, that recent sell-off and the rotation has taken tech stocks down to a 12.3% return for the year, underperforming the overall benchmark 500 index. It's a tech world, and it's going to become increasingly that way, so investors don't want to wait too long to start picking up deals in stocks of this sector, but the sector does have a while before valuations start looking attractive. Again, looking at that FactSet earnings insight, tech stocks are trading for a price of 28.5 times forward earnings expectations, a 37% premium to the sector's long-term average, around 20 times PE. I would feel more confident were that ratio to fall closer to at least the 5-year average, around 24 times PE, before jumping back into these sector stocks. Now that doesn't mean tech stocks have to fall considerably more though, but still need time for earnings to catch up with valuations. We see here that earnings in the sector are expected up 19% this year and 20% in 2025. So tech stocks could start looking attractive by the end of this year, even if prices don't fall further just on those rising earnings. Looking at the stock market news this week, it is an exceptionally busy week for the market. We begin with the busiest week in corporate earnings, seeing 171 companies in the S&P 500 report their profits. Nearly half, or 40% of companies, have already reported, with an average 9.8% increase in earnings over the second quarter of last year. If that average holds, it's going to be the highest growth in nearly 3 years. For the full year, analysts do expect companies in the S&P 500 to report 10.9% earnings on 5% revenue growth. That's contributing to my view here that even if we see those small corrections along the way, the bull market is still firmly intact. The Federal Reserve wraps up its 2-day policy meeting with a rate decision at 2 p.m. Eastern met Wednesday, followed by a press conference by Chair Powell. Now, according to the CME FedWatch rate tool, the market is still pricing a 95% likelihood that the Fed keeps its benchmark rate target at 5.25% to 5.5% here, but investors are going to be watching for any change in the statement that signals a rate cut in September. With that downward trend in inflation over the past 2 months and a weakening job picture, the market is now pricing in 87% odds that the Fed cuts at least 0.25% in September, and 13%, so 100% rate cut bets, but 13% that it goes even further to a 0.5% cut or more. Now, if all that weren't enough, we finish up the week on Friday with the non-farm payrolls report, the monthly jobs picture, which is expected to show just 190,000 jobs were created last month versus 206,000 jobs the month before. Now, while the unemployment rate is expected unchanged at 4.1%, hourly wage growth is expected to slow from 3.7% from last year versus a 3.9% pace to last month. Even another surprise read around 205,000 would still confirm a weakening economy and keep those September rate cuts on the table, while a surprisingly low jobs number could put the odds at even bigger for a rate cut. Either way, the report is likely to be supportive of stocks, and you need to be ready. See the stocks I'm buying and join more than 150,000 investors on the Blossom Investing app. Look for the invite link in the description below, or click on the video to the right for the 7 tech penny stocks that could jump in the next wave of AI. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.